David, when I want to value a stock, for example, it takes me a few seconds to, click and go on the internet and find out what a stock
Yeah.
is worth. If I want to value a house, I can look up Zillow equally quickly, or I can look at, sale like comps in the neighborhood, how many bedrooms, whatever. I
Yeah.
can maybe spend 30, 40 minutes on a house and walk through it and have a good idea of what it's worth. How long does it take to value a business?
Yeah, we typically say from the time in which we have all the documents that we're requesting, and that list is longer than you might think, but let's just say that it could be anywhere from 20 to 40 things, because it's an in-depth exercise. From the time that we have all the information, we can usually turn around a report in maybe 4 to 6 weeks. And so maybe longer than expected, but there's a lot of analysis and back and forth, management interviews and things of that nature that go into it.
Welcome back to the Money Seed Podcast. My guest today is David Amiss. David is an accountant specializing in business valuation. David, welcome to the show.
Hey, thanks so much for having me. I'm excited to be here.
David, it's not every day that we speak to somebody who is a credentialed business valuation expert. How did you get into this space?
That's a great question. So way back when in college, I was introduced to business valuation and some of the concepts, and at the time, I was enamored with it, but also scared by it. I considered it a lot of art then, and so I went the traditional accounting path and worked in that space for 10 or 15 years, and after a while, began wanting to do something else, and so picked up that interest, that flame that I had in college, and carried it a little bit farther, and found out that valuation is an art for sure, but it's also a science, and so it's something that maybe I always had my eye on, and made my way back to it, and so excited to be in that space now.
And do you mainly work with small businesses or large companies?
Yeah, it's probably small to mid-sized companies. I don't know how many large companies we do. Right now, I've worked on a valuation and issued a report in the last couple of weeks for a company that may be worth $500,000, and there's another one we're working on that they're going to be worth $60 million. And so, depending on the business and multiples and things of that nature, it can go up in a hurry. But small to mid-sized businesses.
David, when I want to value a stock, for example, it takes me a few seconds to, click and go on the internet and find out what a stock is worth. If I want to value a house, I can look up Zillow equally quickly, or I can look at, sale like comps in the neighborhood, how many bedrooms, whatever.
Yeah.
I can maybe spend 30, 40 minutes on a house and walk through it and have a good idea of what it's worth. How long does it take to value a business?
Yeah, we typically say from the time in which we have all the documents that we're requesting, and that list is longer than you might think, but let's just say that it could be anywhere from 20 to 40 things, because it's an in-depth exercise. From the time that we have all the information, we can usually turn around a report in maybe 4 to 6 weeks. And so maybe longer than expected, but there's a lot of analysis and back and forth, management interviews and things of that nature that go into it.
I think most of our listeners probably own a small business if they own a business, but let's just take a typical small business. Let's say it is a family-run operation. Mm-hmm. Pick a business. Let's say car wash, right? Yep. You have a typical car wash. The building is owned. Let's say they might have a mortgage on it, they might not. What are the biggest things that go into trying to determine what a business is worth? Yeah.
Well, typically on a business like a car wash, we're probably going to be utilizing the income approach or the market approach, and the only other approaches out there are the asset. But the asset approach oftentimes doesn't capture the intangible value, right? So oftentimes we use the income approach, and the way that the income approach gets at the value of a company is by determining the benefits measured in either net income or earnings or cash flows each year. And then we convert that benefit amount, annual benefit amount, to a value, and we do that by dividing it by the rate of return, right? And so, if you're going to invest in a stock and you're going to give X dollars for that stock, what's the annual benefit you're going to get, and what's the annual appreciation you're going to get, and you may be willing to accept a smaller amount if it's a less risky stock. Conversely, if it's more risky, you want more return. And so when we value that car wash, we're going to go in there. We're going to say, hey, what's this car wash done in the last 5 years? How much? What's the revenue and what's the net income? We're going to remove some of the owner discretionary amounts, right? Maybe the owner's paying $5,000 a year for vacation. Let's get that out of there. That really doesn't have a business purpose, and it's kind of cluttering things up. But we look and see what sort of benefit, right, return that business is producing, and then we determine a discount rate, which reflects the return on investment that an investor would want. And then so we take the benefit and divide it by the discount rate, and that equals value. The other thing you mentioned, you talked about comps, and so in certain industries, there's a lot of companies that are selling, and so and we can harvest data, from other transactions, and if we get 25 transactions or more, and we feel good about the sample of the population, then we can begin to understand, well, for every dollar of revenue this company sold, for, right? And we can come up with price to revenue multiples, et cetera, and we can apply those to our company. Now, whether or not we rely on those, that's something else, but we may let that corroborate our income approach. And so I just talked a lot there. How does that sound? Does that make sense?
It makes a lot of sense. And I think the way that you were describing, the rate of return, et cetera, it sounded like it's analogous to the cap rate. Like if anybody is trying to invest in multifamily real estate, they look at the cap rate, and it's a number that everyone in the industry understands. And if you know what the cap rate is, then you can kind of back calculate your monthly cash flows and figure out what the multifamily property is worth, give or take.
Yeah, that's exactly it. And so, it's as simple as benefits, again, measured in either earnings, net income, or cash flows divided by a cap rate. And now a lot goes into the numerator in that formula and the denominator, but that's it, I think. And if you understand that, then you're well on your way to understanding, valuation theory, principles, et cetera.
David, tell me a little bit, how does the actual effort required to keep the business going, how does that factor into evaluation? And what I'm thinking of primarily here is, some businesses I might invest money in and it's relatively low effort. Like I may only spend 5 hours a week on a business. And there are some businesses, like I'm thinking of restaurants here, that are really time intensive, where you might be spending 50, 60 hours a week there. And yet both businesses might generate the same amount of profit at the end of the month. Yeah. Does that come into play?
I think it comes into play as we're trying to model out like what are the market expenses, or what are reasonable expenses, right? So every business owner has, with some exceptions, has the ability to pay themselves whatever they want, right? If they're working 80 hours and they're paying themselves $20,000 a year, well, that's just not reasonable, right? If you and I were to go buy this business, and we had to replace that person, what's it going to cost to replace that person? And so I think that's where that comes in. Hey, what are the owners doing? What are the key people doing? Are they workaholics and working 75 hours a week? Well, if market comp for that, for just a normal salary, normal working is 50, what it's got to be more than that. And so I think we show the cost by adjusting owner compensation there. And so and that's how it affects the valuation.
And tell me, what does your typical client look like?
Yeah, we do valuations for the three main functions, right? So we do some valuations for family law, right? Husband and wife, one of them owns a business, maybe both of them own a business. In equitable distribution, we got to split up the marital estate, so we do it there. So they are the client. Could be the attorney, it could be the divorcing husband or wife. We also do valuations for estate and gift purposes. The estate tax exemption is it's like $11 million or $12 million right now, or $24 million if you combine husband and wife. There's, not a lot of folks have estates that are $24 million, but that exemption is scheduled to sunset in 2026. And so as we continue to move towards 2026, if the exemption comes back to 11 million for husband and wife together, well, that's potentially, problematic if you have a business that's worth a lot. So sometimes we're working with businesses who say, gosh, I want to, protect my estate. Let's go ahead and do some gifting, and we can take advantage of some discounts. And that's a whole other discussion, but we can essentially plan and be strategic, and save our heirs, save the people that are going to, get these assets. We'd hate for, sons, daughters, grandkids, et cetera, have to sell assets and generate gains in order to pay estate tax. So that would be a second reason. And then another one is mergers and acquisition. So baby boomers own a lot of businesses, and there's a thing coming that they call it the silver tsunami. Essentially, all the baby boomers that are selling businesses, and they own small businesses. They own that car wash, and maybe they own a couple of them, and they're looking to get out. And that they made it through COVID, and they took a hit during COVID, and now they made it through, and they're thinking about how do we monetize this thing and get out. So we also work with those folks and trying to help them understand what their business is worth, and maybe sometimes if it's not worth as much as they think it is, helping them understand where some of the additional risk is coming from. Right, going back to your cap rate comment. If the cap rate's too high, well, that's driving down the value, right? The higher cap rate reduces the value. Well, if we try to diversify our customer base here, or pour into management and develop a deeper bench for our employees, that's valuable, and that reduces risk. And so we work in that space as well.
That's fascinating. I just always assume that whenever somebody wants to value a business, they always want it to be valued more rather than less. But it sounds like there are some tax implications. For example, you mentioned estate tax, where it may make sense to, like you said, try to do some gifting, or try to do some other things to try to lower the value of the business. That's quite fascinating.
Yeah, it is. It goes for sure on estate. That happens on estate. Also, if somebody died and they own a business, and they're going to transfer that business to an heir, and a lot of times in those cases, if it's not a taxable estate, those people will want a high value because they're going to get a step up in basis, and they want a higher basis. So whenever they sell the business, they have less gain, right? And so I feel like on every valuation, I have somebody in my ear saying, I want it higher, I want it lower, and we understand that we're being hired by these folks, but what we say it, and we try to say it graciously and gently, but we are advocates for our value. We'll tell you why the value is what it is, and we'd love to talk about the report. But we're not hired guns, and so we've got to be advocates for our value and our value alone. So it can be tense at times.
What am I paying you for?
Yeah, exactly right. I told you it's worth this. Well, great, but you save your money. You don't need to hire me. But so yeah, exactly.
And through your over decades long experience here valuing businesses, are there any type of businesses that really stand out that tend to be valued higher than, say, similar businesses?
Yeah, I think those a lot of times manufacturing businesses are there, or service-based businesses. But I think each of them are, at the end of the day, each of them are different. And this is why the valuation exercise takes 4 to 6 weeks. Depending on if a company has been run inefficiently, there's capacity, and somebody with the right management can get in there and really take advantage of that and benefit from it, right? And we've got to understand, where is this business, in relationship with its industry? Where is it in relationship with the economy, with the broader economy, local economy? Is it earlier on in its, in its life cycle, or later? Because that changes cost of capital, capitalization rate, right? If it needs long-term debt, well, the cost of capital is going to be lower, right? Because debt's cheaper than equity. But if it's later on and doesn't, so there could be some, but it really varies based on all those variables. And that's not trying to be a cop out. It's what makes it fun and difficult.
How does someone become certified in business valuation?
Yeah, there are three primary credentialing bodies. And so one, the AICPA, the American Institute of Certified Public Accountants, they have a credential called the ABV, Accredited in Business Valuation. There's the National Association of Certified Valuation Analysts, and they have a CVA, Certified Valuation Analyst, which is what I am. And then there's a American Appraisal Society, and so they have their own designation. And with each of those credentials, there's an education requirement, there's an experience requirement, and there's an examination requirement, and of course, the annual or the triannual recertification process.
David, I believe now you are a published author. Tell us about your book.
Yeah. So I was probably credentialed 7 years ago or 8 years ago in valuation. And I was doing that on the side, I guess, anywhere from 10 to 25% of my time. But I just got to a point where I wanted to go completely or go all in, as they say, in valuation. And so, like I said, one of the types of valuations that I do is for family law. And I believe that the difference in the practice that I have, just kind of going all in right now, and the practice that I want, a lot more valuation is really a credibility gap, an authority gap. And so I think, how do we increase authority? Well, we write and we speak, and so I wrote a book, and so I wrote a book on valuation, and it's titled Introduction to Business Valuation for Matrimonial Lawyers. And so it's geared towards matrimonial lawyers, but there's also a sense in which, at the end of the day, business valuation is business valuation, and what applies for family lawyers also applies for other lawyers, and it applies for business owners. And so I wrote a book, and it really just trying to be an easy to read, a simple book. There are a lot of valuation texts out there that are 4 or 5 inches thick, and they're valuation books written by valuation people for valuation people. This book was not written for valuation people. It was written for people that don't have a finance background, right? Attorneys or business owners, and try to help them understand. Well, you mentioned cap rate. What is the cap rate? How do we determine the cap rate? And really a very simple, easy to read, about 200 pages book on valuation.
You mentioned some of the basic techniques earlier. What are the 4 or 5 most common ways to value a business?
Yeah, I think I would say capitalization of earnings, and that's where we pick a period, a benefit, and we capitalize it, and that's probably one. Another one would be the discounted cash flow analysis, and so we use that when the historical earnings vary a lot, and we really can't get a good read on it, and we don't know what's going to happen with this company, or if management expects the company to go through a tremendous period of growth, like in the next year, say 20% next year, 15% the following year, and then kind of flatten out to 3%. So there, we want to do a discounted cash flow analysis where we project the earnings for a couple of years in the future, and then present value them back. Okay, so I think those are 2 income methods, and then the other common one. So I'll give you 3. Is we call it the guideline transaction method. That may not be a good phrase, but how about mergers and acquisition method, where we look at data from mergers and acquisitions, and then we apply that data to our company to see how we match up. It's a comp approach, right? Just like in a real estate appraisal.
And how standardized are these approaches? And I guess what I'm asking is, if it ever ends up in court, right, whether it's, divorce court, or maybe one business partner is suing another one, and one team has their valuation, their valuators, another team has their valuators, do different business valuators end up with similar numbers at the end of the day?
They should. We should. And this is a point of frustration for me. Those methods that I mentioned to you are pretty common. I think that when we do valuation, and it's going to be in a litigation setting, we do have to be careful. We have to be aware of the statutes, of the state statutes, and the case law. The specific case law for matrimonial litigation may be different than shareholder disputes, and some of the things that you consider or not consider. But those three methods are pretty common. Now, to the other issue of differing values, because sometimes I'll have to value the company for the wife, and somebody else will value the company for the husband, and we're never going to be exactly the same, but we should be close. And so there is bias that happens, and that's unfortunate. What we do is subjective. There are judgment calls. If we're adjusting reasonable compensation for the owner, the president, CEO, owner, is it 150,000 or was it 200,000? Well, there may be data out there that says that 150 could be on the low end of reasonable, and that 200 could be on the high end of reasonable. If the difference in a value of a company from a 15% cap rate to a 20% cap rate is significant, right? And so there are differences, but we should be in the ballpark, and so people are going to be advocates for their value, so it happens probably more often than not, more often than I care to say out loud.
David, as we move to wrap up this interview, tell me, where can people find your book and where can people reach you?
Yeah, so you can find the book on Amazon. It's there. Just search Introduction to Business Valuation for Matrimonial Lawyers. David Amiss, obviously, writing it. Feel free to email me. My email address is just the first initial D, and then last name Amiss, AMISS, and then at CRICPA.com. And you can email me, and if you'd like a copy of the book, I'd love to get it to you. So
fantastic. I'll drop those in the show notes. David, thank you very much for your time today. Fascinating discussion, and I hope to speak with you again soon.
All right. Thank you so much.
Hey, thanks for joining us for another episode of the Money Seat Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.